And in our top business story, Saudi Arabian oil company Saudi Aramco has signed two separate MOUs with the Abu Dhabi National Oil Company ADNOC and with Masdar, Abu Dhabi's renewable energy company. The MOUs cover energy and technology collaboration, renewables and carbon management, and under the terms between ADNOC and Saudi Aramco, the two companies will collaborate on identifying technologies that could deliver improved operational performance and efficiency across the oil and gas value chain. The MOU was signed by His Excellency Dr. Sultan Ahmed Al Jaber, the UAE Minister of State and ADNOC Group CEO, and Amin Nasser, President and CEO of Saudi Aramco. According to His Excellency Dr. Al Jaber, the agreement reinforces their renewed approach to partnerships which are aimed at leveraging and building on existing industry expertise. Since taking over the helm of ADNOC in February 2016, Dr. Al Jaber has moved rapidly to implement a level of change and has stated previously that a different approach to partnerships will help ADNOC meet ambitious targets for its 5-year business plan and the broader 2030 goals. Saudi Aramco also signed a memorandum of understanding with Masdar in which the two companies will collaborate on sustainable development and renewable energy to yield advancements in clean electricity generation and carbon capture for Saudi Arabia, the UAE and the world. Saudi Arabia has ambitious renewable energy targets under its National Renewable Energy Program. The official plan for installing 9.5 gigawatts of renewable energy by 2030, with the interim target of 3.45 gigawatts by 2020. The merger between First Gulf Bank and National Bank of Abu Dhabi was formally completed on Sunday as the Board of Directors unveiled a new name for the bank. In a statement, the Board of Directors announced that the merger entity would be named First Abu Dhabi Bank, subject to regulatory approvals and following a General Assembly meeting to be held at a later stage to approve the name. The name, according to the company's directors, reflects the new bank's deep roots and experience in the region. However, the bank began trading on the Abu Dhabi Securities Exchange on Sunday, listed under ticker symbol NBAD. The merged bank becomes the UAE's largest bank and one of the biggest in the entire Middle East and North Africa region, with total assets in excess of 670 billion dirhams and a market capitalization of around 111 billion dirhams. Dubai's residential market contracted during the first quarter of 2017, with rental rates falling by an average of 1% quarter-on-quarter over the period. CBRE's latest Dubai Market View said the dip was driven by an increase in available housing options amid more constrained demand. Meanwhile, according to the report, landlords are becoming increasingly flexible with rental rates, with tenants able to now better negotiate. Residential sales prices remained relatively stable during the period, declining by less than 1%. According to Matt Green, the head of residential research at CBRE Middle East, amidst a flurry of off-plan launches, the competition to attract investors is rising, meaning developers are having to become more creative in order to sustain desired levels of sales velocity. Dubai's commercial sector, on the other hand, has remained relatively robust, according to CBRE. The report said the office market has not witnessed any major shift in activity levels. There remains sustained demand for good quality accommodation in prime areas, and average prime rentals remained unchanged quarter-on-quarter at 1,920 dirhams per square meter per annum. The report said that Dubai's hospitality sector continues to witness declining revenues despite a 5% year-on-year rise in visitor arrivals to 14.9 million during 2016. Citing figures from STR, CBRE said that average daily rates across the emirate were down by around 5% in the first quarter, while revenue per available room was down 1.3%. As foreign direct investment in the Dubai real estate market reached nearly 44 billion dirhams last year, leading property developers from Dubai and abroad at the 13th International Property Show are showcasing the latest projects for both end users and investors. This year, the Dubai International Property Show is permitting on-the-spot sales and transactions as per the Real Estate Regulatory Agency RERA rules, and is also playing host to some of the world's leading real estate destinations such as Portugal, Cyprus, the United States and the UK. while stating that Dubai supports a wide range of buyer profile, including end users, expats, long-term investors and first-time buyers. Event organisers highlighted that Dubai's market is less sensitive to external factors and also encourages expat spending, unlike other countries. With more than 22,834 investors from 136 nationalities eyeing all property segments from mid-range to upmarket luxury housing in Dubai last year, developers at Dubai Properties stressed that Dubai will continue to be a favourite real estate investment destination, maintaining its status as a stable and mature property market. One of Dubai's leading developer, Dubai Properties, this year has announced the launch of its latest project, the Mudon Views, located at Dubai Land District. And the first phase of the launch includes 1-, 2- and 3-bedroom apartments in 2 buildings, which will be part of a larger integrated residential community.
Dubai has been very well known that property in Dubai has been escalating, stabilizing the rental, stabilizing the capital appreciation, and to an extent that we are one of the leading property markets with a strong governance, which was created by Dubai Land Department now. Dubai Land Department enforces the rules and regulation that protects the investor. So this all platform that supports the property market of a growth from fundamental to an execution, it's there. So we are looking very positively towards market 2017, and Dubai Properties will be one of the major players in this market, shaping the future.
A lot of new buyers, would obviously prefer to test the water with maybe a smaller investment. So there's a demand for not very high end, I would say, more of middle class or lower. Some luxurious product, but they want it to be a bit smaller to see how it moves forward. And if they're happy with that experience, then they would go ahead and buy more things. So the trend is furnished properties, trend is smaller properties, and obviously location is very important as well. They want to see the yields, rent, how it's going to be, reselling the property.
Well, London, along with Sydney and Los Angeles, are still leading the pack in the global real estate market. Property developers in the UK stressed that although London's property market suffered initially after Britain's exit, it has stabilised in the last few months, with many investors now going back and appreciating the long-term potential of the British capital in the European Union or not.
What we're showcasing from Maybridge Capital, which is a capital investment company based in the UK, and we've got a couple of properties under development in the south of London and the south of the UK as a whole. Now, your main question concerning Brexit and its current impact on the British market. On a short-term basis, I would recommend every investor not to invest their money on expensive property in centre of London due to the market's current volatility. But in the UK as a whole, and it's always been chronically undersupplied with cheap housing. So when you invest in current housing, I would say under market valued housing, you're more likely to have a better ROI in the long term. So I would recommend everybody to go for lower priced properties in the south of London, north of London, but most, I would say, on the south of the UK as a whole. That would be the best outlook in the future.